So let's review chapters 17 and 18. So this first question says that Metz Company had these transactions in 2019. We need to indicate whether each transaction resulted in a cash flow from operating activities, investing activities, financing activities, or non-cash investing and financing activities. So we have a list of transactions here. The first one, issued $50,000 par value common stock for cash. So the first question is cash involved? Yes, cash is involved. So it's either going to be operating, investing, or financing. Now, if we are getting cash because we are issuing common stock, anytime that happens, that's a financing activity. Now, purchased a machine for $30,000, giving a long-term note in exchange. Here, there's no cash that's involved, right? We are purchasing a machine and giving them a notes payable. So, if that's happening, that means that this is a non-cash activity because there's no cash that's involved in this transaction. Now, issued $200,000 par value common stock upon conversion of bonds having a value of $200,000. Once again, there's no cash involved here. You issued stock while converting bonds. So there's no cash, so it's a non-cash activity. Next, you declared and paid a cash dividend of $18,000. So good news, we're back with cash, right? So we know it's either going to be operating, investing, or financing. And then we need to think about if dividends paid, where would that go? Well, anytime that you pay a cash dividend, that falls under financing activities. The next one, sold a long-term investment with a cost of $15,000 for $15,000 cash. We know right off the bat that cash is involved. And then there's that key word in there, investment. So that's an investing activity. So we have a few more transactions here on the next slide. You collected $16,000 of accounts receivable. So if we are collecting accounts receivable, that means that people are paying us money. So cash is involved. And accounts receivable is a current asset. So changes in current assets fall under operating activities. Now, paid $18,000 on accounts payable. Accounts payable is a current liability, right? So we are paying off a current liability. So that involves cash. And it's going to change the balance of that current liability. And any time that a current liability changes, it falls under operating activities as well, right? So operating activities have both the changes in current assets and current liabilities. So now we can put all of this together and actually prepare a statement of cash flows. So it says Rojas Corporation's comparative balance sheets are given. Prepare a statement of cash flows for 2017 using the indirect method. So we're given balance sheet information for 2016 and 2017, along with some additional information down below. We're told the net income. We're told that dividends were paid out. No non-cash investing or financing activities occurred. And the land was sold for cash of $4,900. So we're going to go piece by piece on this balance sheet and figure out what are we going to use in the statement of cash flows. So first, let's take a look at cash. Cash did increase from 2016 to 2017. That's what we are having to explain here in the statement of cash flows. So we are going to explain how did it go from 10,700 up to 14,300. One of those reasons is because of accounts receivable. We can see that accounts receivable decreased by $2,200. Went from $23,400 in 2016 down to $21,200 in 2017. We also see that land decreased. Because remember, under additional information, we were told that we sold some land. So our land decreased here by the $6,000. Our buildings didn't change. And then our depreciation. We went from $10,000 up to $15,000 in our accumulated depreciation. So we had an additional depreciation expense of $5,000. Accounts payable. You can see accounts payable changed a lot, right? It went down $18,000 between 2016 and 2017. And common stock increased. So, we can now look down under additional information. We had a net income that we're going to need for a statement of cash flows. We were told that we paid dividends of $19,500. That's going to be important. And then if we look at part C, it says the land was sold for cash of $4,900. That $4,900, we're going to call that the proceeds from the sale. So that's how much money we got the buyer to give us. But when we compare the proceeds from the sale up to the amount of land that we actually sold, there's a difference there. On the books, the land was worth $6,000 to us. But we only got $4,900 for it. So there's a loss. There's a loss on the sale of that land for $1,100. So now we have all of those individual pieces. And we need to figure out whether it's operating, investing, or financing, just like we did in that first problem. So accounts receivable decreasing. Well, we already said changes in current assets and current liabilities, that's operating activities. Depreciation expense. Depreciation expense is a non-cash expense. Non-cash expenses fall under operating. And we'll see why once we start putting together our statement of cash flows. Accounts payable. That's a current liability. Current liabilities, just like current assets, go under operating. Now, common stock. Common stock increased, which means that we issued some stock. And whenever we issue stock, that's a financing activity. Net income. Net income is the very first thing that you put in your operating activity section. Now, dividends paid. Dividends paid is part of financing activities. Proceeds from the sale of land. So anytime that you buy or sell buildings, equipment, or land, that is an investing activity. So we put the proceeds from the sale under the investing activities section. And then we have this loss on the sale of land. Now, the loss on the sale will not go under investing. Instead, any gain or loss that you have will go under the operating activity section. So we have all of that information in the upper left, and we will start making our cash flow statement. So the very first thing that we put is cash flows from operating activities. So we need to just focus on operating activities here. And our first line is our net income. So we write out our net income of $22,630. Now, why do we start off with our net income? Well, because everything else are adjustments to reconcile net income to net cash provided by operating activities. We want to show just how much cash did we get from operating activities. So we start off at our net income, we make a few adjustments here and there, and that will show us how much cash we got from operating activities. So we had a few different pieces here for operating activities. The first one was your decrease in accounts receivable. So we need to be thinking, what would a decrease in accounts receivable do to your cash? Well, if accounts receivable is decreasing, that means that your customers are giving you money. So that's going to be a positive $2,200. Now, your next piece is depreciation expense. We said depreciation expense was a non-cash expense. And here's why it goes into operating activities. Because we need to adjust our net income, right? Our net income would have decreased because of this depreciation expense. But just because something's depreciating doesn't mean that we are paying any money, right? Our equipment depreciated, we didn't have to write a check for $5,000. So, non-cash expenses like depreciation expense have to be added back in on a statement of cash flows, because that artificially took down our net income, even though we didn't have to actually pay any money. Our next piece, decrease in accounts payable. Well, what would be happening if our accounts payable decreased? That means that we are paying money to people that we owed, right? So, to make accounts payable go down, our cash has to go down as well. So we show that as a negative $18,730. And then we just had one other piece here in operating activities, our loss on the sale of land. A loss would also be taken away while finding your net income. Same sort of idea as what we just talked about with depreciation expense. A loss is subtracted while finding your net income. But you didn't have to actually pay any money just because you had a loss on the sale. Right? So we have to add back in that $1,100 for the loss on the sale of the land. So that's all of our operating activities, but we're not done with that section yet. We add up those four adjustments, so $2,200 plus $5,000 minus $18,730 plus $1,100, and we end up with a negative $10,430. Now, that does not mean that it's net cash used by operating activities. We still have net cash provided, which means that we still made money with our operating activities. And how is that possible? Because that amount is your net income minus $10,430. So if that $12,200 amount was negative, then it would be net cash used by operating activities. But since it's positive, it's net cash provided by operating activities. So we have one section down for our statement of cash flows. So now we can move on to the next section. The next one will be investing activities. We only had one investing activity, right? The proceeds from the sale of the land. So we'll write sale of land, and we think, would this increase or decrease our cash? Well, if we sold land, we're going to be getting money, right? So that's going to be an increase in our cash. So we're going to show the $4,900 as a positive number. And since it's our only investing activity, we can just toss it over on the far right and call it a day for the investing activities section. If we had multiple, we would have to figure out our net cash provided or our net cash used by investing activities. But since we just have one, we're good with just that. So then we can move on to our cash flows from financing activities. We had two of those, right? We had our common stock and our dividends. So we first go with our issuance of common stock. So our common stock increased. We issued more stock, which means that we ended up getting money. So we need a positive $6,000 for the issuance of common stock. Now, the next piece was the payment of dividends. If we pay dividends, that's us losing money. So what do we need to do? We need to show that as a negative amount, a negative $19,500. So we can figure out our net cash used by financing activities by taking $6,000 minus $19,500, leaving us with a negative $13,500. Right? And since that $13,000 is negative, that's what makes it net cash used by financing activities. If it was positive, it would be net cash provided by financing activities. So once we have those three sections down, we can then find our net increase or decrease in cash. And the way that we do that is we take our net cash provided plus, or net cash provided by operating activities, right? The $12,200 plus our net cash from investing activities, the $4,900, minus our net cash used by financing activities, $13,500. And if you do that, you'll end up with a positive $3,600. So that shows that our cash increased by $3,600 throughout 2017. The next piece is the cash at the beginning of the period. This is the 2016 amount on our comparative balance sheets. Right? That showed up as $10,700. That's what we had at the end of 2016. And then at the end of 2017, the cash at the end of the period was $14,300. So we explained through this statement how we went from $10,700 in cash up to $14,300 in cash. So now question number 3. The following data are from the income statements of Haskin Company. We need to compute the inventory turnover and the days in inventory for each year. So, inventory turnover. That's going to be your cost of goods sold divided by average inventory. Unfortunately, they don't give us either of those in our information. They give us the pieces that we can use to find it, though. So, cost of goods sold. That's going to be your beginning inventory plus your purchases minus your ending inventory. We're given all of that information. So for 2017, we plug in our beginning inventory, our purchases, and our ending inventory, and we find out that our 2017 cost of goods sold is $4,260,000. Then, average inventory. That's going to be our beginning inventory plus our ending inventory divided by 2. For 2017, we plug in our amounts, and we see that our average inventory in 2017 was $980,000. So now we can find our inventory turnover. For 2017, we plug in the numbers that we just found for our cost of goods sold and our average inventory. And our inventory turnover is 4.35 times. So we turned over our inventory a little over 4 times that year. So now days in inventory for 2017. What we do there is we take 365 divided by our inventory turnover. So 365 divided by 4.35, and we can see that on average our inventory spent 83.91 days in our warehouse. Now we can do all of this for 2016. It's going to be the same process. We need to find our cost of goods sold. So we plug in 2016's beginning inventory, 2016's purchases, and 2016's ending inventory, and we can find our cost of goods sold for 2016. Now, our average inventory. We plug in the beginning and the ending inventory for 2016, and we divide by 2 to get our average inventory for that year. So now we can plug in that cost of goods sold and average inventory that we found to find the inventory turnover for 2016. And we find that our inventory turnover for 2016 will be 5.09 times. So we turned over our inventory a little bit more in 2016 than we did in 2017. Now, days in inventory. We take 365 divided by that 5.09 that we just found, and inventory spent roughly 72 days in our warehouse in 2016. Now question number 4 says the comparative condensed income statements of Navarro Corporation are given. We need to prepare a horizontal analysis using 2016 as the base, and then prepare a vertical analysis of the income statement. So let's first focus on horizontal analysis. They told us that 2016 was the base. That means everything is going to be compared to the 2016 amount. So when doing horizontal analysis, your base year, they're all 100%, right? Because if we took the net sales amount in 2016 and divided it by itself, we'd get 1 or 100%. And we do that for each individual line. So then we can take a look at 2017. Net sales. We're going to take $660,000, which was our net sales amount in 2017, and divide it by the net sales amount from 2016. We get 110%. So net sales increased from 2016 to 2017 by 10%. Now cost of goods sold. We take 2017's cost of goods sold and divide it by 2016's cost of goods sold, and we get 115%. So now we can take a look at gross profit. 2017's gross profit divided by 2016's gross profit, we get 98.3%. Operating expenses, we take 2017's operating expenses, divide it by 2016's operating expenses, we get 104%. And then net income, we take 2017's net income divided by 2016's net income to get 86.7%. So there's a few different ways that you could spin this information, right? Our gross profit and our net income didn't look so great compared to 2016, right? We went down in both of those, but our net sales increased. So let's say this is your company and you want to get some positive news out there about your company in 2017. Sales increased by 10%. Now, that doesn't tell the whole story though, right? So that's why it's important to look through more than just one single piece of an income statement. Now we take a look at vertical analysis. So vertical analysis of an income statement, everything is compared to net sales. If we were doing this for a balance sheet, everything would be compared to total assets. But let's take a look at vertical analysis here. So vertical analysis, we don't have a base year. Because vertical analysis, you are working in a singular year at a time. So for net sales in 2017, what we would do is we would take 2017's net sales and divide it by 2017's net sales. For 2016, we would take 2016's net sales and divide it by itself. So we get 100% for our net sales because our net sales are 100% of themselves. Now, cost of goods sold. We're going to take 2017's cost of goods sold, divide it by 2017's net sales, and then take 2016's cost of goods sold and divide it by 2016's net sales. So we see our cost of goods sold as 73.2% in 2017 and 70% in 2016. Now, gross profit. We're going to take each individual year's gross profits and divide it by that year's net sales. And we end up with 26.8% and 30%. Operating expenses, we take 2017's operating expenses, divide it by 2017's net sales, and then we take 2016's operating expenses and divide it by 2016's net sales. We get 18.9% and 20%. Now our net income. We take 2017's net income divided by 2017's net sales and 2016's net income divided by 2016's net sales. We get 7.9% and 10%. Now, you might have noticed a pattern with these numbers. As you move down an income statement, you would go net sales minus cost of goods sold equals gross profit. Well, that works for these percentages here as well in a vertical analysis. Gross profit minus your operating expenses gives you your net income. That also works for your vertical analysis. Now, an important piece here. When we were working with horizontal analysis, that's called trend analysis, so we can compare year to year. When we're working in vertical analysis, we don't really want to compare year to year too much. Because if we take a look at our operating expenses, for example, if we just look at the percentages, well, 2017's percentage is smaller than 2016's. But if you look at the raw data itself up in the upper right, your operating expenses were actually higher. So since we don't have a common denominator when we're doing vertical analysis, it's difficult to compare year to year.